Good day, fellow investors. One of the key criticisms I have listened to the last few years, and actually rightly so, was that I haven't beaten the market, the S&P 500. And there were also these comments like, you will lose money, blah blah blah. The thing is that I did beat the market since I started my research platform. The last few months have been great for me, for my model portfolio. The S&P 500 remained flat and my performance is now above the S&P 500. So I made the calculation. I was updating something on my platform. I just said, okay, let's make the calculation since the start, and I have done 14.5% return yearly compounded, the S&P 500 including dividends 14.3%. So I have made here the calculation on the model portfolio. It was started in 2018, 5,000 initial investment, 250 monthly additions, 6.75 years have passed, estimated interest rate. The calculation according to the government's compounding calculator is 43,386. I am $7 less than that. But okay, comparing to the S&P 500, annualized 14.31. We started end of May, start June 2018. So, not that it is relevant, but I just wanted to make a videos for, I first thought I would say pundits, but actually those are my greatest and most important followers and actually drivers to make me work harder and better. I made a lot of mistakes and I'm working hard to correct those mistakes. Yes, mistakes, despite, again, beating the market, despite doing a good return, I have made too many mistakes for value investing. But what I want to discuss here is a little bit on the market, value investing, and also my goals going forward. Because if we look at the S&P 500 over the last 6 years, it's doing great. And actually, that is a key risk also in my perspective. Because if I look at, since I started my research platform portfolio, the S&P 500 has almost doubled since then. And if you look at things from a longer term perspective, this is adjusted for inflation, but usually returns are measured without calculating for inflation. Look at the market expansion periods. So I have done well compared to the market, despite this being a huge bull market. So it started in 2009 below 1,000 and now it's 6,000 and higher. And that is a market expansion phase compared to the 1980s, 1990s, another market expansion phase, compared to the 60s, 50s, another market expansion phase, and also the roaring 20s. The thing is that when it comes to such market expansions, usually each expansion is followed by 25 years, 20 years, 12, 15 years of zero returns with 86%, 50%, 50% twice declines in the meantime. And that is the key here, because the market gained a lot due to that market expansion by an expansion in valuation, just a P ratio going from 20 to 30. So if I look at the price-earnings ratio of the S&P 500, we are now at above 30. However, when I started in 2018, we were around 22. So there was a 40% expansion in valuation over time, which means that from 4,000 to 6,000 points, all else equal, is just a valuation expansion gain. And yes, it is hard for me to say I'm going to beat the market if valuations keep expanding. I know what I am capable of doing, value investing fundamentals. I don't know what the market will do. And since 2018, I compete with zero interest rates, with pandemic money printing, with money coming directly to your bank account for 2 years, 7% budget deficits that balloon financial assets, economies, AI and other bubbles. And that is the mantra, because after 15 years of stocks only going up, everyone expects that the Magnificent Seven and all these great businesses will just keep going up. Nobody looks at price, and that makes it also difficult for us value investors. We can still do good, it takes a lot of work, but we are doing that. We have to look at the fundamentals. If you are targeting a 10% return when it comes to investing, I think it's very hard to achieve with a 1.22% dividend yield of the S&P 500. Also, there is the risk. If the valuation reverts to the historical mean, that's just that valuation is minus 50%. So when you look at historical dividends, those were 4%, that's minus 75% if interest rates make a trick on the market. Just to compare things, I have calculated the weighted average P/E ratio of my current model portfolio, and the P/E ratio is 12. So when we are comparing things, risk and reward, we are comparing a P/E ratio of 30 versus 12. I have food, I have hedges, growth also. There might be a recession, but these businesses are likely to survive recessions and grow forward. And this is, let's say, my conservative long-term targeted return. As said, over the last 7 years we have done 14.5%, but if I have a P ratio of 12, 8% earnings yield, 5% growth, that could lead to a 13% return from fundamentals. Now, I hope to underperform the market. I'm very happy that I reach 15% over the next 7 years for the model portfolio, and I'm happy, inflation being low, of course, I'm very happy that the market does 16% and that every one of you tells me how the market has beaten me. I know the risk I'm taking, how I'm building those returns, versus the driver of returns for the market. That's the key difference. Whether I beat the market or not is absolutely irrelevant. And if we just keep on looking at the market, when I look at this, the exuberant estimations for Wall Street, so even if all those earnings growth of 14% over the next 2 years are met, even then the P ratio would still be above 20. Which is something very expensive for my value investing taste. So going forward, again, I wish everything works well, that the markets keep on working well 10% per year, but that is an unlikely situation that this financial bubble lasts forever. So it is more likely that, from my personal perspective, I go into separation from the markets like I did from 2002, that we cannot even compare my returns. I would still be a poor kid if I had invested in the S&P 500 in a great year to start investing in the S&P 500, which was 2002. I have to limit the number of mistakes. That's value investing. You make mistakes, but as you buy with a margin of safety, those mistakes don't cost you that much. And I'll keep focusing on value investing. I'll keep compounding. I hope the market does the same, and that in 7 years, maybe even the market beats me, but that is also then to be seen. Another benefit that I have, if you look at my research platform, there are the covered stocks, but now I have 7 years of detailed research on various sectors, countries. It is so much that we have done over the last 7 years, and this knowledge also compounds. So that is again an advantage, plus the experience, plus this. If you want to check my research platform, don't get overwhelmed. Everything is here in the top of it. Here you have the now updated. I will update it tomorrow. I'm filming this the evening before. So the buys, the portfolios, everything there you can check, and then you can see how it fits your risk and reward requirements when it comes to reaching your financial goals. Thanks for watching. Check it out. I'll see you in the next video.